Is the Celestica Tokenized Stock derivative by Ondo Finance a groundbreaking evolution in real-world asset tokenization, or are investors completely blind to an impending structural breakdown? Right now, the CLSon asset is trading at a premium price of exactly $337.73. It is flashing a completely flat 0% change over the last 24 hours. The volume is completely drying up, the order books are stagnant, and behind this deceptive calm, the macro charts are looking incredibly dangerous. On almost every major time frame, the trend is printing lower highs, key structural support blocks are cracking, and institutional analytics dashboards are actively screaming sell. Yet, despite this clearly visible technical decline, a highly vocal sector of real-world asset proponents and deep-value DeFi traders are pounding the table. They insist that at this specific price point, this tokenized equity is massively undervalued because it tracks a dominant player in electronic manufacturing and cloud data center infrastructure. Are these buyers forward-thinking visionaries securing a blue-chip asset at a generational discount, or are they blindly walking straight into a highly complex, beautifully packaged institutional value trap? Let's strip away the corporate marketing, ignore the noise, and dive straight into the on-chain data to dismantle this asset piece by piece. To truly understand why Celestica Tokenized Stock is dominating advanced DeFi discussions today, you have to look directly at the underlying mechanics of what Ondo Finance has built here. Unlike a standard cryptocurrency, meme coin, or abstract algorithm, CLSon is a tokenized security. This asset is synthetically tied to the performance of Celestica Inc., a global giant in supply chain solutions, high-tech manufacturing, and enterprise cloud infrastructure. By wrapping this real-world asset onto the blockchain, global investors are theoretically able to trade institutional-grade equity 24 hours a day without banking intermediaries. Celestica itself is in sharp focus right now because the entire artificial intelligence infrastructure and enterprise hardware supply chains are experiencing intense macroeconomic pressure and cyclical inventory adjustments. When the real-world equity market experiences turbulence, capital floods into these tokenized varieties, creating massive tracking pressure. However, the core challenge right now is that the token's trading velocity hasn't matched its face value, and secondary market liquidity is becoming a massive systemic issue. Before we break down the technical chart patterns and structural vulnerabilities, do me a massive favor, smash that like button, subscribe to the channel right now, and leave a compulsory comment below with your exact playbook. Are you holding your CLSon positions, taking advantage of this flat consolidation to buy the dip, or are you liquidating your bags before a breakdown? Drop a comment right now because your real-time input drives the algorithm and keeps these deep dive analysis videos alive. Now let's pull up the technical chart analysis, because while corporate public relations teams can manipulate sentiment, the order books, automated pools, and price action never lie. When you zoom out to the daily and weekly charts, CLSon is locked inside a definitive descending triangle pattern. The price has been making lower highs for several consecutive weeks, compressing tightly against a critical multi-month support floor. If you look at the major moving averages, the 50-day moving average is sloping steeply downward, acting as a massive dynamic iron ceiling every single time the bulls try to initiate a minor relief rally. Momentum indicators like the Relative Strength Index, or RSI, are currently hovering in the low 40s, right on the border of a deep bearish breakdown. This tells us that buying pressure has completely evaporated from the secondary markets. The volume profile is dangerously thin, meaning it takes a tiny fraction of institutional sell orders to completely slide the price, while moving the asset up requires an immense amount of buying power. Short-term strength is completely non-existent, and the horizontal support floor is the absolute line in the sand for this tokenized asset. If this level breaks on a daily closing basis, there is a total lack of historical order blocks beneath it, which could trigger a rapid descent to find a new macro bottom. When you shift your gaze to the analyst ratings and smart money flow signals, the broader outlook gets significantly darker. Institutional tracking dashboards and compliance intelligence layers are currently marking this specific tokenized product as a strong sell or heavy hold. The negative signals are accumulating rapidly behind the scenes, particularly through on-chain transparency data. Over the past month, Wallet analytics reveal that several large-scale liquidity providers and decentralized treasury whales have been steadily distributing their holdings into the retail market, using periods of low volatility to exit their pools. When the primary liquidity engines and major institutional backers are trimming their exposure, it creates an incredibly heavy overhead supply wall that makes a sustained market recovery nearly impossible. Furthermore, institutional sentiment indicators highlight that the lack of primary market redemption efficiency during volatile days is keeping smart money on the sidelines. The short-term outlook strongly implies that unless a massive, unexpected fundamental catalyst occurs within the Ondo ecosystem, the path of least resistance for this price remains firmly down. This reality brings us directly to the ultimate, highly polarized debate. Is Celestica Tokenized Stock deeply undervalued, or is it a dangerous value trap designed to lock up retail capital? The bullish faction argues that at $337, the asset is trading at a significant discount relative to the corporate giant's multi-billion-dollar industrial footprint and AI hardware dominance. They believe that as real-world asset tokenization scales and traditional finance continues to merge with Web3, tokenized enterprise equities will capture massive market share, making this an elite accumulation zone. The bear camp, however, views this perspective as a highly dangerous misunderstanding of synthetic and tokenized asset risks. A value trap occurs when an asset looks highly attractive simply because its nominal price has stabilized, while its underlying structural mechanics, secondary market demand, and tracking liquidity are actively decaying. If a tokenized security cannot maintain deep, continuous liquidity pools and tight redemption efficiency against the underlying physical equity, a premium price tag doesn't make it a bargain. It just makes it a structural hazard on its way to a massive correction. The downside risks embedded in high-value tokenized securities like CLSon are absolutely massive, and retail traders get brutally trapped in these exact market setups every single day. The primary reason retail investors suffer devastating, catastrophic losses in these institutional ecosystems is a fundamental misunderstanding of synthetic liquidity structures. Traders look at the high dollar value and think, this tracks a real NYSE stock, so it is inherently safe from total collapse. What they completely fail to realize is that on-chain tokenized derivatives carry unique, independent layers of protocol risk, smart contract vulnerabilities, and severe liquidity constraints. Because these high-priced tokens often have highly illiquid order books compared to traditional equity brokerages, they are subject to extreme, sudden volatility spikes. When a broader crypto market panic hits, liquidity can completely disappear from the automated pools in a matter of seconds. This creates a worst-case scenario known as catastrophic slippage, where your portfolio dashboard might display a value of over $300, but when you actually try to execute a market sell order, the total lack of depth forces your transaction to fill at a devastatingly lower, unoptimized price, wiping out massive amounts of capital instantly. Let's clearly outline the absolute best-case recovery scenario versus the worst-case bear continuation. In the absolute best-case bull scenario, Ondo Finance announces a massive cross-chain integration, secures a Tier 1 institutional banking partner for automated arbitrage liquidity, and Celestica Inc. reports record-shattering earnings. This fundamental breakthrough would force short sellers and market hedgers to rapidly buy back tokens, triggering an explosive short squeeze that could violently drive the price back up toward major psychological resistance levels at $380 and $400. On the flip side, the worst-case continuation scenario is supported by significantly more historical chart data. If the immediate support floor fails to hold during the next broader cryptocurrency market correction, automated stop losses will trigger a cascade of liquidation orders. This panic selling could easily result in a brutal 40% to 50% liquidation event within a single trading day, leaving late-stage retail buyers holding a highly illiquid asset that they cannot redeem or sell. Looking at the comprehensive outlook, we are watching two completely separate timelines unfold at the exact same time. In the immediate short-term perspective, the overarching macro trend is undeniably pointing straight down, and fighting that trend is historically a financial death sentence. Expect continued choppy price action, stagnant sideways movements, and deceptive fake-out pumps as high-frequency trading algorithms aggressively exploit retail emotions at these lower bounds. From a long-term perspective, the survival of the CLSon token relies entirely on the platform's ability to transition from a niche, illiquid trading vehicle and establish real, seamless economic utility for global asset allocation. Without a structural overhaul in how the asset peg is defended and an expansion of cross-chain liquidity access, the long-term chart will inevitably continue to mirror the short-term macro decline.